Hello, I'm Mario Becker, founder and CEO of Das Family Office, a Singapore-based multifamily office. We've just released our quarterly publication, Reflections, and in the following video, I'm summarizing the content a little bit. I hope you're finding it useful. The first half of 2023 brought a lot of pleasant surprises. We've seen a massive rally in the Nasdaq 100 index based on the excitement for AI, artificial intelligence and related businesses. Stocks like Nvidia, Microsoft and so on had a tremendous run. This was wonderful, especially after we've seen such weakness in 2022. Also, the bond market stabilized. So for medium and long-term bonds, we saw some price appreciation, we saw higher interest rate payments. So net, the first half was a really good period for the markets, and our investors were smiling. This continued into July, but ever since August, we've kind of reached this seasonal weakness. Traditionally, August, September, October is a weak period, based on the fact that there's not so much information. At the same time, a lot of traders are on holiday. So there have been a lot of instances in the last many decades where this period was on the weaker side. And again, we've witnessed that this year, maybe because we've had such a very good first half. At the same time, the dollar strengthened again, the oil price rose again. And I think most of all, what's important is that the messaging from the central banks has changed. Some of the positive market environment of the first half was also that many market participants assumed that the central banks, namely the Fed and the European Central Bank, would slowly come to an end to their interest rate raising campaigns. So the bond markets were actually quite stable for medium and long-term bonds. Only short duration bonds were impacted by these ongoing interest rate rises by the central banks. But the narrative, as we say, has now changed. The new narrative is higher for longer. So that means whoever expected that the Fed and potentially also the ECB would cut interest rates in a major way next year have been disappointed, because this new messaging is that don't expect the central banks to cut in a material way anytime soon. And we can see that at the changes of the US yield curve. We see a little bit of a so-called uninverting. So that means an inverted yield curve means interest rates at the short end are higher than at the long end. But what we're seeing now is that interest rates at the long end are moving higher. So the inversion that we've seen earlier in the year, so that long-dated bonds would yield sometimes more than 1% less than short-dated bonds, has now changed. We're now seeing a spread of only about 0.5 to 0.75. And that could be an indication that there may not be a recession in the US. And it could also be an indication that the Fed can cut just a little bit and thereby effectively uninvert the yield curve. And naturally, rising interest rates means losses for bondholders. And we've seen that in the third quarter. A lot of the bond portfolios have suffered, and suffered to some degree more than some of the equity portfolios. But on the equity side, we've seen a lot of weakness in so-called long duration stocks. That means technology stocks that don't have such great earnings, but where we expect significant future earnings, and also smaller company stocks. They've had weakness in the third quarter. Overall, we can say that for the broad-based equity markets and equity investments, the gains of the first half are largely in tech. They're just a little bit less. But small company stocks have suffered a lot. Their returns are effectively cut in half. On government bonds, we've seen that they've effectively, all the gains of the first half have melted away. Only portfolios with corporate bonds and some specialty bonds like the Tier 1 capital and the bank capital that we've mentioned earlier in the year, they've been faring a little bit better. Also, some of the emerging market bonds have been faring a little bit better. So yeah, significant weakness in Q3, but still overall a good year 2023. We're now entering the fourth quarter, and I would imagine that after October things could slow down a bit, some of the volatility could disappear, because if we're looking at current valuations, and please take a look at our publication Reflections where we show this in detail, you can see that the current yields and equity risk premia are materially higher than the long-term inflation expectations. They are around 2.5%, and pretty much all our building blocks are yielding much more than this. And what you can also see, many of our bond building blocks, which is quite unusual and something we haven't seen over the last decade, some of these bond building blocks are yielding more than 6%. So that means we're getting into a return range which is traditionally left for equity and equity risk. I think we can state that certain bond markets are looking truly attractive, and we should consider adding them to our portfolios. Where I think I would still be a bit careful is valuations in the Nasdaq 100 and also the MSCI World Quality Index are still a little bit lower than historic returns. For equities and for the quality segment, we would expect, for normal equities 6 to 8%, but for the quality equities, and which are often also represented in the Nasdaq, we'd probably expect a bit more, maybe 7 to 9 or 7 to 10%. So current risk premia of about 5 to 5.5% are on the lower side. So one shouldn't expect too much here. I mean, naturally, as we've witnessed in the past, these companies grow their profits at a good regular interval. So valuations will gradually come off as these companies improve, as these companies grow their earnings. But it may well be that for a while these stocks will underperform. That's not to say that we would sell them, but we would probably not add to them at current valuations. Overall, for those who don't know us so well or don't know us at all, we're following a so-called fair horizon concept at Das Family Office. That means we're helping our clients to build portfolios that add equity risk as the time horizon, the investment time horizon, increases. And we do that because it's a given that high quality equity portfolios deliver the highest long-term returns. So if you put money to work for the really long term and you don't invest significantly in equities, you're leaving money on the table. And we're trying to avoid that at Das Family Office. At the same time, if you don't know when you need certain money, you should be very careful. And nowadays, you get paid by holding just money market instruments. For example, we have high quality money market instruments which are currently yielding between 6 and 6.5%. So you actually get paid for waiting and making up your mind what you want to achieve in the medium to long term, which is very pleasant compared to just only 2 years ago. That said, I'm wishing you all the best for a wonderful fourth quarter. If you don't know us, have a look at our website, have a look at our publication Reflections, and contact us via email. We'd be delighted to work with you. Yours, Mario Becker.